Good morning. I hope you're well. Another incredibly volatile month. The good news, or at least I hope it's good news, is that good news is now bad news, and a decade ago, where bad economic news means that markets rally, as it's likely the Fed will hike fewer times. Markets, they are quite something. So good news is bad news is good news. And not only that, but August saw a lot of volatility. Markets rallied at the beginning of the month quite strongly on weak, bad economic data coming out of the US, weak growth and weak employment numbers. And then during the middle of the month, the market fell on very strong US JOLTS job numbers before recovering slightly at the end of the month on weak job data that came out in the form of non-farm payrolls. So quite a roller coaster. Every time a different data point came out in the States, the markets either rallied or fell quite dramatically. Meanwhile, as you can see on this chart, in the green there, emerging markets up 3.5% for the month, China up 5% for the month. So EM and China kind of quietly got on and did its thing, while the rest of the developed world was consumed by rising interest rates and inflation numbers. The EU being hardest hit with the soaring energy prices, and that's definitely one of the biggest risks that still overhangs markets, and I'll talk more about that later. But yeah, the big winners there, dollar cash, you can see up 3.7%, and EM and China, and that followed through into the fund performance for the month. Look at 1 month performance for August, you can see there, number one for the month was the Emerging Markets Fund, 2.5% return. Number three, the China Fund, 1.6% return. But generally, if you're looking at 1 month return, very much a story of thematics. All the thematic indices and funds doing very nicely. Emerging markets, China, you can see the Divi at number two continues to do very nicely, which is our value proxy in South Africa. Fan Fund, number four, our large internet platform theme. And fourth industrial revolution coming in fifth at 1.1% return. It's our innovation technology theme. Over the 12-month period, it's still very much a value story. Berkshire Hathaway and the Divi funds topping the pop still there on a 12-month story. The other interesting thing is that as rates are rising around the world, income is starting to look more and more attractive. Not only at the long end, I mean, bonds have been attractive for quite some time. You can see there the Sygnia Enhanced All Bond Fund now has a running yield of 10.4%. The All Bond Fund, a yield of 10.1%. Income Maximizer, a yield of 9.7%. But the Enhanced Income Fund has now got a yield of 8%. That fund has no duration. And it is just basically a very long dated money market fund, but you're getting a juicy return of 8% as interest rates have risen and are going to continue to rise over the next year at least. So the income funds starting to look more attractive now after interest rates have risen. The bottom of the chart there is our Global Income Fund, one of our UCITS funds, giving a 2.6% return in dollars, which is a pretty decent dollar return. With a very little duration. It's an income fund, only 1.4 years. If you are interested in our UCITS funds, they are available on the Momentum platform, as well as the Glacier and Old Mutual platforms. And right now it's the Global Income Fund. It's also our Fourth Industrial Revolution Fund in dollars, and our Healthcare Fund is also available in dollars. And towards the end of October, we'll be launching our China Fund on the UCITS platform as well. That's the Prescient platform, or Manco. So yeah, at least the volatility is starting to lead to more decent returns from income, and that's putting pressure as interest rates are rising globally. That is certainly putting pressure on gold and other commodities, which are proxies for safe haven assets, but without any yield. But as I mentioned, when we're looking at the markets and what's driving the markets, it really is in terms of the tail risk and uncertainty. It's really about Europe and Russia. And when I say Europe, it's very much Europe driving the sanctions, and how Russia is then squeezing the natural gas or energy, oil that comes out of Russia. And the situation deteriorated quite rapidly over the last few days. with the G7 imposing a price cap on Russian oil, and as a result, Gazprom shutting down Nord Stream 1 indefinitely. And here we've got Kremlin spokesman Dmitry Peskov, with Putin's right-hand man, saying Gazprom is supplying as much gas as necessary and as much as possible. And Gazprom blaming the shutdown on technical factors, saying that the sanctions on Russia are not allowing necessary components to come through to fix the pipeline. So as long as there are sanctions, there's not going to be full gas flowing through. And this to and fro is likely to continue as each side tries to raise the pressure. But it's not only the fact that natural gas supplies have been squeezed, and they certainly have. If you look at the top right-hand chart there, you can see natural gas supplies from the various pipelines going into Europe have dwindled significantly. But it's also there's been a lot of demand. The EU has been desperately trying to fill up its gas storage, and it looks like it's going to be able to meet that need 2 months ahead of schedule. So a lot of gas going into storage, which has been putting on additional pressure onto prices. And European energy prices have certainly skyrocketed and have led to a bit of an energy crisis. There are, of course, a lot of things that are going to happen in terms of price caps and ways that that's going to be managed, but generally a lot of uncertainty in Europe as a result of energy prices. One of the things that is helping the story is that oil continues to fall. Oil remains below $100 a barrel, even with OPEC cutting production by 100,000 barrels a day. The oil price continues to sink below $100 a barrel, and that at least is deflationary to some extent from an energy standpoint. So while natural gas prices are peaking, at least oil continues to roll over. And that tends to be our base case, that barring any escalations in Europe or Russia, markets should continue to recover. Global inflation surprise index has rolled over, driven by crude oil in particular, which is down more than 20%, and it's been down for 3 months in a row. But food prices are also down 11% over June and July alone. So a lot of the inflation increases or inflationary pressures we saw over the last 3 months over the last 6 months, I suppose, have reversed over the last 2 months. And that's feeding through into lower inflation numbers. But at the same time, if you look at the bottom right-hand chart, it's not just that prices are rolling over, but global supply constraints are easing. Those are mostly supply constraints which are driven by COVID, and those bottlenecks are reducing. You can see there how that's nearly back to a neutral level in terms of supply constraints. We've also got positive data coming out of the Conference Board leading economic indicator, which is not negative. It's at 0, but it's not negative. The 3-month 10-year bond curve is also not very positive, but it's also not inverted. And while PMIs have been soft, they're also showing significant signs of disinflation. And finally, the Goldman Sachs Financial Condition Index shows that financial conditions have, unlike any time in the past, have constricted ahead of policy. And I think a lot of that's to do with quantitative tightening, and the QT resulted in financial conditions tightening ahead of interest rates being pushed up. So even though the Fed was behind the curve in raising rates, QT meant that the Fed was actually ahead of the curve. So a lot of the data points that are out there continue to point to the fact that we think markets are going to recover over the next 6 months. Yes, there's risk. Certainly, Europe and Russia is a big risk. But what's driving the markets has been, ex-Russia and Europe, what's driving the rest of the world has been inflation and rising rates. And that inflationary pressures are certainly rolling over, which should lead to central banks allowing financial conditions to ease somewhat. And that allows us to be bullish going into the next 6 months. But it's still very much a Fed story. We had Jackson Powell being very hawkish Jeremy Powell being very hawkish at Jackson Hole this month, just warning basically that the Fed can't tighten too soon. So if you look at what markets are predicting, the Fed is going to hike rates this year quite aggressively, but then next year the Fed is going to start cutting rates. We had Jeremy Powell and the Fed come out and say, no, markets have got it wrong. They're going to keep on hiking. They're going to hike this year and they're going to hike next year, warning that to get inflation under control, is going to require a sustained period of below trend growth. And trend growth is 1.8%. So that's certainly, I mean, that's quite a fear-mongering statement to make. But that's his job. The Fed is there to try and drive fear into the markets so that inflation expectations drop, and the Fed achieves their goals of keeping inflation in check without having to destroy the economy and raise rates. So completely as expected, he's going to be hawkish. The FOMC is going to be hawkish. The Fed is going to be hawkish. That's their jobs. They need to get inflation under control, hopefully without having to raise rates too much. So that was hawkish, but hawkish as expected. There was also a very interesting report that came out at the Jackson Hole. Each year when they get together, they discuss a number of research reports. And the one that was one of the highlights this year was looking at employment versus hours worked, and just how the whole economy has changed around the world after COVID, and how a lot more people are working flexi time, or working at home, or working a couple of hours a day. And so the actual employment numbers don't mean as much as they used to in the past. But hours worked is starting to mean a lot more than it has in the past. So the Fed also, and central banks generally, struggling to keep up with what is important these days as the world goes through a change. And I think obviously we're all struggling to deal with these changes, but it's interesting how it's impacting monetary policy at its core. But as I said, the market started off August in a euphoric manner, rallying really hard, and it was on CPI in the US, which not only peaked and came down to 8.5% year on year, but was below expectations, and then was confirmed with PPI, which also peaked and was below expectations. So the markets were generally very, very happy with low inflation and low growth data coming out of the US earlier on the month. And we do think this is going to continue, that with the supply disruptions out of the way and oil and food prices rolling over, inflation is set to fall quite quickly, from the 9% down to probably 4%. But it's going to be tricky getting it down to the final 2%, which is obviously the Fed's target. And a lot of that's to do with wages. Unemployment remained close to its lows. It ticked up a little bit at 3.7% from 3.5% at the end of the month. But that same time means that employment is still very, very strong. And strong employment, along with cooling inflation and record household bank savings balances, 2.2 trillion higher than pre-COVID, is all helping consumer confidence recover. And it's also one of the reasons why the US is missing 2.6 million potential workers. Since pre-COVID, 2.6 million potential workers have not come back into the labor force. And that's one of the reasons why unit labor costs, if you look at the top right-hand chart, are so high. One of the reasons why wage prices are so high. The US is missing workers. And it seems quite hard to explain until you look into the data and you realize that the US is still printing money. So anybody who was furloughed during COVID and was receiving checks, basically money being printed and put into a bank account, they're now still receiving close to $1,200 a week if they at least set up an interview and prove that they're trying to, well, I don't even know if they have to prove it, but as long as they have interviews and pretend that they're trying to get jobs, they're getting $1,200 a week, which is way higher than the minimum wage. So the fact that if you drive around the US and you see help wanted signs in every restaurant and every service industry, it makes sense. I mean, why would you take a minimum wage job if you can get paid more to sit at home? So I think that the US has got some issues in terms of the fact that it's still printing money. The bottom right-hand chart there shows how the labor force participation rate hasn't picked up. It's still below its pre-COVID levels. And that's because right now it makes sense to sit at home and do nothing. But that won't continue forever. It can't continue forever. And at some point, those people will come back into the labor force. But until then, there's certainly going to be wage pressure, and that's going to put pressure on margins, which is going to put pressure on US earnings. So it's one of the major reasons why we are underweight US. We are very worried about US margins, not just the fact that margins are under pressure with unit labor costs rising, but the fact that the ratio between capital, shareholders, and labor wages is at a 60-year high, which is not sustainable. It needs to mean revert at some point. And with wage inflation coming through strongly now, it gives employers a chance to put some pressure on. So we do think there will be some pressure on margins in the US going forward. So looking at unemployment in particular, it's no surprise that unemployment is remaining at its lows and it's not rising quickly. If you look back at the recessions of 1980, 1990, 2000, 2007, they all had about 2 years of flat unemployment before unemployment rose dramatically. And markets all did really well in those 2 years. And it's one of the reasons we do think that markets are going to continue as a whole to recover over the next 6 months. Looking further out, when the Fed needs to try and stamp down inflation, well, then things get a bit more tricky. But the Fed is also aware of this dynamic, and that's why they are, while the Fed was so, while Powell was so hawkish at Jackson Hole, they're trying to short circuit this 2-year wait and get inflation to permanently step lower a lot sooner than would otherwise have happened. So we remain in this tussle between economic growth and inflation in the US, with good news being bad news and bad news being good news. Right now, we think that most of the bad news has been priced in, and that the Fed isn't going to be too more hawkish over the next 6 months, which will allow markets to continue to rally, which will be good for the whole world. But at the same time, we remain underweight the US because of margins. So the two major things driving the world right now, it's one is Russia and Ukraine and how that impacts energy prices in Europe, particularly through natural gas. And that's certainly weighing on the euro and weighing on European shares. And we remain underweight European shares. The other big issue is what's happening in the Fed and the US in terms of inflation and how much interest rates have to rise. And it's also leading to a lot of volatility, and we remain underweight the US as well. So a lot of anxiety, a lot of issues that are coming towards Europe with inflation, and coming towards the US with the interest rates, which are rising, causing a lot of volatility. So we remain underweight those two regions. China, of course, we still are very, very happy being overweight China. We think that they're ahead of the curve by 18 months. And there's a lot of government support coming into that market, and interest rates are still being cut. So, and a lot of positive signs coming out of China. Of course, geopolitics remains a risk. And when we had Pelosi visit Taiwan, China sold off at the start of the month before recovering later on. And we had President Xi here who said to Joe Biden that whoever plays with fire will get burned. And yes, it certainly is a risk. There is a risk that China could invade Taiwan, and it would definitely be a very high impact event. I mean, effectively it would be World War III, because the US would need to get involved. But we think the probability is incredibly low. China now has the largest navy in the world, and the US has got so many problems to deal with Iran and Russia. They just can't afford to get involved in Taiwan. So we think, yes, saber rattling will continue like it has for the last 40, 50 years, but it's unlikely that anything's going to accelerate. So while it's a high impact event, it's a very, very low probability event, and certainly not something that we price for. More importantly, looking at China, things are looking good. Again, more very positive rhetoric coming out here. Premier Li saying that he vows to use all of the tools available in the toolbox to make sure that employment recovers, to make sure that growth recovers. We saw the People's Bank of China cut the key rate by 10 basis points to 2.75%. The China State Council came out with a 19-point stimulus plan, which allocates a further trillion yuan to funding infrastructure spending. That's on top of the 300 billion they announced in June. So more and more policy support. What's even more supportive is the fact that despite isolated COVID flare-ups that happened in August, China's services sector has held up. So the preliminary numbers that are coming through. If you look at the bottom right-hand chart there, the Caxton Services indicator shows that the services sector has held up despite mini lockdowns happening through China. So we really think that the China's zero tolerance policy is not as zero tolerance as it used to be, and it's not going to hamper growth in the way that it did. At the same time, we've also got China's quest to let 100 flowers bloom coming through very strongly. US and China have reached a deal allowing the US regulators to audit Chinese companies which are listed in the US. And it's very positive for the big dual listed Chinese stocks. Chinese electric vehicle battery installations rose 114%. Chinese vehicle exports increased 64% year on year. I mean, that's looking quite incredible. I don't know if any of you have seen the new H6, the new Haval that's on the roads, long waiting list to get some of those in South Africa. Pricing points are incredibly attractive, and the car looking pretty decent compared to its competitors. So certainly China going from low cost to high quality in its exports around the world, and that's certainly helping Chinese growth. So everything seems to be pointing in the right direction. If you look at the 31 fastest rising academic institutions that are around the world, they're all based in China. That's, again, an incredible data point. Top right chart shows Chinese IPOs surged to 44% of global market share, up from 13% last year. Again, just a lot of positive data coming out of China, the world's largest economy on a purchasing power parity basis, nearly the same size as the US on a dollar basis, and a lot of positive stuff coming through, a lot of positive growth compared to the US, where it's all about trying to raising interest rates, try and tame inflation. You're earning -5%, -6% real terms on US cash deposits, whereas in China you're earning positive real return on your cash deposits. I certainly would much rather have my capital invested in China right now, even though they're not as capitalist focused as the US. They just seem to be looking after growth and education and capital better than the US right now. So China remains one of our long-term themes as part of our emerging Asia next billion middle class, which we see coming through in emerging Asia, and we remain positive on EMs as a whole. But we need to quickly divert. I did promise I'd talk about Canada and Australia and New Zealand. Certainly it's somewhere where a lot of people like to move to, if not move their capital to, but like to move themselves there and immigrate to those countries. So it's interesting to see what should be done. And definitely we've had some decent market pricing coming out of Australia, coming out of Canada and the UK, all of which have been supported by rising energy prices. But when it comes to our favorite of those three, we think there certainly are some headwinds when it comes to Australia and Canada and New Zealand. And here you've got the Bank of Canada Deputy Governor Paul Baudry warning that a frenzy of real estate investment combined with impossibly high levels of household debt could destabilize the Canadian economy as interest rates start to rise. And that's certainly something that we are concerned about. If you look at here on the chart on the right, it shows house prices to rental, basically the cost of buying a house relative to the cost of renting a house. And those rental prices are also looking quite expensive. But even looking through that, just at a price to rent basis, you can see the New Zealand top of the pops having increased 3 times the cost of buying a house relative to the cost of renting a house over the last 2 decades. Canada close in second place, 2.5 times. Sweden in fourth place, Australia in fourth place at 1.6 times. Japan seeing some price deflation, and the US up, and Germany up only 40% over the last 2 decades. So that's despite having zero interest rates in the US. Those price houses have not increased much, which at least bodes well for the US house pricing going forward with as interest rates rise. Certainly they will be a lot more protected than New Zealand, Canada, and Australia. But we remain positive on commodity economies. We think rising energy prices have already supported the UK, Australia, and Canada, but we prefer the UK. FTSE 100 has outperformed the FTSE 250 by 26%, and that's because FTSE 100 is not really a UK index. It's a global index, and it's got a very high share of value companies. It's got a very high share of energy and gas companies. So we still remain overweight the FTSE UK. We've got the Sygnia UK ITRIX ETF, and we think that's a good place to be. We are neutral on Australia and Canada, but we certainly aren't going overweight. We're very worried that even with the positive commodity news, and that the housing sectors could lead to a slowdown in those economies. But when it comes to commodities, we think that a lot of the bad news has been priced in. Copper saw its worst losing streak since 2008 on Chinese growth fears, but broader commodities should find a base. particularly those benefiting from decarbonisation. So that is copper in particular, lithium and silver, all should do quite nicely. And those metal prices and industrial metal prices will stabilize as China continues with its policy support and supporting the property sector and supporting infrastructure, all of which will lead to stabilized commodity growth. And the other thing that's quite interesting right now is that, yes, in the beginning, as energy prices soared, industrial metal prices collapsed because everyone was worried about demand falling because of recession. But now we're seeing the other side starting to impact the supply side. We're now seeing load shedding happening around the world because of high energy prices, and that's leading to a shortage of supply. So although it's been a bit of a lag, the same impact or the same cause which lowered demand is now lowering supply as well. It's not only are we starting to see demand starting to recover, at the same time we're seeing supply starting to slow down. So yes, we do like, we think that the commodity sector has got some legs to run, particularly on the back of ESG, particularly those commodities that are going to benefit from decarbonisation. We're not big fans of Canada and Australia just because of the housing markets. We do continue to like the FTSE 100, but in particular, we like emerging markets, partly because of China, but also partly because of the petrodollars that are being recycled and the exposure you have got to the Middle East through Saudi Aramco. So Saudi Arabia's public petroleum and natural gas company, Saudi Aramco, posted the biggest quarterly adjusted profit of any listed company globally ever. It's just quite an astounding, forget Apple, forget Google, forget Amazon. Saudi Aramco posted the biggest quarterly adjusted profit of any listed company globally ever, $48.4 billion in the second quarter. And that's just on the back of higher petrol and natural gas prices. I mean, it's an astounding number. And that company fits in the emerging market index. It is there. And here you've got, Nasser, CEO of Saudi Aramco, saying that we expect oil demand to continue to grow for the rest of the decade, despite downward economic pressure on short-term global forecasts. Basically, oil demand is not going to go away anytime soon. And that's going to, particularly right now with inflated oil prices and natural gas prices, Middle East is seeing record high revenues, and those will be recycled into emerging markets. But that's not the only reason why we're bullish on EM. Strategically, from a long-term perspective, we do like emerging Asia, emerging middle class in Asia. But right now, there are also some sweet spots in emerging markets. India is relatively protected from a global slowdown. Only 12% of GDP is from exports. So India will continue to grow nicely, even as the rest of the world slows. We've also got in Indonesia, Malaysia, and Vietnam doing very nicely because they're all net food and energy exporters, so they will continue to be protected. Mexico and Brazil are also doing very nicely. They don't see the energy prices impacting them as much as emerging Europe, and they're benefiting from being close to the US, which is still growing quite strongly. And so there are a lot of sweet points. But from a broader EM perspective, what we really like is this chart on the right, which shows acceleration or deceleration of headline CPI in emerging markets. So as oil prices fall, as food prices fall, although it did curtail EMs quite dramatically, it's also going to fall off very dramatically. You can see the US inflation falling the fastest, but EM inflation also falling equally as fast. With the euro area staying a lot higher because of the natural gas prices, which are feeding through to longer term inflation in Europe. But that's going to allow EM central banks to be a lot more dovish and to slow down on their rate hikes, which will then allow growth to do a lot better in emerging markets. So EM is not just a China story, but also some sweet spots that do well, and more importantly, we're going to see more dovish central bankers in emerging markets. So we continue to be overweight EM, which is starting to see its headwinds become tailwinds. Now, I always have to take a drink of water before moving on to South Africa. And here we've got our Deputy President, David Mabuza, saying that the nearly 50 billion rand that municipalities owe to Eskom at the end of July is not a desirable state of affairs. Well, that's being very euphemistic. In general, consumers owe municipalities, South African consumers owe municipalities 225 billion rand, which in itself is not a concern. The concern is that 86% of that is unlikely to be collected. 86% of that is likely to be written off. So that's a lot of debt that's not going to be collected. And municipalities, in turn, then owe creditors 90 billion rand, of which Eskom is 49 billion. So municipalities are not going to be able to pay Eskom or other creditors if they can't collect from their own consumers. So we do certainly have some bottlenecks in South Africa, which are not going to help. But the story in South Africa very much remains an energy story and load shedding. APSA's July PMI dropped to the lowest level in 12 months on the back of the electricity crisis. And it just speaks to the lack of government support or reforms around Eskom. So the top right-hand chart is quite something. It shows how South African private sector has really come to the party. We're talking companies that have put solar panels on as part of their processes. Residential consumers putting solar panels on their roofs, but commercial solar cumulative capacity has nearly doubled in 2001, and is likely to increase another 54% in 2022. So it's huge strides by the private sector to move off the grid, or at least supplement Eskom. Meanwhile, back on the government side, we have the risk mitigation independent power producer program, which was the emergency risk mitigation program to try and stop load shedding, which came out nearly 2 years ago. That was supposed to have started generating output this month. The RMIPPP was supposed to start producing power this month, August 2022. We've now got only 7.5% of those producers who've concluded their financial arrangements, let alone started to build the plant. So that's way behind. At least we had President Ramaphosa come to the party, and they've now removed licensing requirements from 100 megawatt production. So as you remember a while ago, they lifted the cap to 100 megawatts, but they didn't remove the licensing requirements. So yes, if it was more than 100 megawatts, you could still try and put together a plant, but well, you're allowed to, but still required a license, and you couldn't get a license. So it was basically nothing changed. But that licensing requirement has now been removed. So at least we can the private sector can start accelerating even further, which should lead to some quick supply coming online. At the same time, Ramaphosa also doubled the procurement of the renewable independent power producer procurement program, bid window 6. Bid window 5 it still hasn't really, well, it's closed, but it's still being negotiated. But bid window 6 should hopefully see its first close in September, but it's likely to be delayed. But at least the size of it has been doubled to 5,200 megawatts. But even that's it. Eskom's outlook for the next 6 months, summer, in which case there should be less load shedding than winter, is still 22 days of load shedding over the next 6 months, with 13,000 megawatts of unplanned outages. So they're expecting the unexpected. They're expecting 13,000 megawatts of unplanned outages over the next 6 months. That's just a crazy amount of unplanned outages, and will keep load shedding high on the agenda for at least the next 18 months, if not a bit longer. But we are making strides. Certainly, the removing of the licensing requirement is a great step forward, and yeah, in the next 2 to 3 years, hopefully things will be a lot different. But right now, we're not there. Right now, it's still too early to invest in South Africa, to build a factory and try and create jobs. So we remain underweight South African equities. We remain overweight South African bonds. That outlook hasn't changed. So how does that feed into our positioning? Well, in general, we maintain a well-diversified portfolio. Volatility is going to be high, particularly with low growth and high debt levels and rising interest rates. we expect a lot of volatility, and we're not only in equities, but in bonds and in the currency. And so maintaining a well-diversified portfolio is essential. We also made a couple of changes to our portfolio this month, so I think it's important that we update you on those changes. We have early on in August, we increased our exposure to growth sectors, and we increased our fourth industrial revolution exposure quite significantly. So we now have quite a large overweight in fourth IR, and we are excited about that. We've had a very small overweight for quite some time, and you know that fourth IR has, and innovation stocks in general have seen some headwinds to prices, and the prices have come off. But a lot of that was on the back of rising inflation and rising interest rates. But inflation has peaked in the US. And financial conditions in terms of tightening have likely peaked as well. And yes, while interest rates continue to rise, we think that the number of interest rate hikes that are priced in by the market is very close to what's going to happen. There might be a bit more here or there, but in general, we think that the bulk of interest rate hikes have been priced in by the market, which means that we're certainly going to see a recovery in growth sectors. We're still remaining overweight value because interest rates are going up, inflation is still there. So we've now got a bit of a barbell approach where we continue to overweight value, but we think that certain growth sectors are going to at least bounce back from their lows. They might not get back to their highs, but we definitely think that there's a lot of risk was priced into these growth technology shares. Growth in general is actually looking the cheapest it's been over the last decade. So not that growth is looking like value, but growth compared to its own history is actually looking very cheap. And so it's almost growth now at a reasonable price, or growth at a very reasonable price, certainly not just growth. And that means that it's looking like a much better time to get back into some growth exposure. So we haven't bought any FANG yet, but we have increased our exposure to fourth industrial revolution. We're also going to be allocating next month to further growth sectors when we allocate to our sustainable technology, so our sustainable economy ETF. But I'll talk a bit more about that later. Okay, so maintaining a well-diversified portfolio, increasing exposure to fourth industrial revolution and growth sectors. Commodity exposure, yes, we're not overweight commodities, but we do think commodities on a select basis, the commodities that are going to benefit from decarbonization, it's good to have exposure to those. We like having our exposure to FTSE 100. It's got decent exposure to the natural gas and oil sectors, which will be defensive. At the same time, it's also a value economy. So we're getting our commodity exposure through the FTSE 100. It's not quite focused. In fact, it's not focused on decarbonization that much, but at least it's giving you a broad energy exposure right now. We still maintain our overweight to value. So we think that value is still very, very oversold compared to its own history. And as interest rates continue to rise and inflation continues to rise, industrials and banks and insurers will do well. And those are mostly your value stocks. And so we maintain our overweights to value. And as a whole, we think that we're still on a very low growth, highly volatile environment, and so it's important to look for growth where you can find it. When the world as a whole is slowing down, when growth is hard to find, when revenue at best is going to be moving sideways, which means that growth can be contracting in some of your traditional sectors. You have to find pockets of the economy in the world that are actually going to be growing, either growing market share like innovation stocks, or protecting market share like healthcare stocks, or seeing new market share gains such as emerging middle class. We like to maintain overweights to those themes. The newest theme we've got is sustainability. It's been in the design phase for nearly 2 years. We're very, very excited to be launching our sustainable economy ETF that should be happening on the 28th of September. So please dial in for the webinar. We haven't sent out the details just yet. We're still waiting for final JSE approval, but it's very likely to be the 20th of September. And we'll tell you all about our sustainable economy ETF. Very, very exciting. It's basically a broad climate change fund. It invests. So we do have our Sygnia iTrix S&P 1200 Global ESG ETF. That's an ESG global equity ESG fund, but it uses negative screening. So it removes companies that have got high carbon footprints to try and achieve climate change that way. Our sustainable economy ETF works the reverse. It buys shares in companies that are fighting climate change. So it invests across the economy. It's divided into 4 sectors: infrastructure, which is renewable energy mostly; the primary sector, which is farming and agriculture; manufacturing, which is robotics and advanced materials; and society, which is basically the metaverse. But it tries to find companies that are focused anywhere in the economy that are helping reduce our carbon footprint, helping make the world a better place. And we think certainly that the sustainability is a theme that's got very long-term tailwinds. And we started this long before the Russia-Ukraine war, but renewable energy in particular is going to see an acceleration in terms of demand as European countries try and move away from natural gas, Russian natural gas and Russian oil, to alternatives, which is really only renewables. So we think that there's going to be accelerated demand for our sustainability, and so we're very excited about that. So we'll be allocating to that as well. We still like healthcare, although we did make a bit of a switch. So within our healthcare fund, we've switched out of healthcare, which has done very well over the last 18 months, and have overweighted genomics. And we think that genomics in particular, as a subset and biotech, genomics and biotech in particular, as subsets of healthcare, are again also going to see accelerated demand as a result of the huge amount of R&D that's still happening around COVID, with an extra $22 billion that the US is pumping into COVID research and manufacturing. And so we made that switch. So we've moved into growth sectors for the R. We're going to be moving into our sustainable economy ETF, and also within our healthcare theme, we've switched out of the broad healthcare companies and topped up our genomics biotech sector slightly. We kept our overweight to emerging Asia middle class, which is through China and EM, so no change there. And we maintain our overweight in South African bonds. We also maintain our overweight to global sectors. That's how and we've actually increased our offshore slightly. That's how we got our additional exposure globally, was to go underweight South Africa and put a bit more offshore. So we have increased our global slightly further. We've got various protections and hedges because the rand is looking very weak at the moment. So it is playing with protection. We do think the rand will continue to strengthen in the short term, partly driven by the dollar, which will turn. It's possible to say when it's going to turn. I'm not predicting the peak, but the dollar will turn in the next couple of months. It's stretched to 40-year highs. And when it is stretched that far, even though it might continue going stronger in the short term, it will snap back sometime soon. So we do think the dollar will weaken, which is why we are happy to have those rand protections in place in terms of rand dollar protection. We also think commodity prices will recover, which is also positive for the rand. So regardless of rand specific issues, I know there's a lot of political risk going into end of year in South Africa, and that will have a small impact. But I can promise you that if the Fed cuts rates, or we see a weakness in the dollar for other reasons, it's going to far outweigh anything that we do as a small open economy in South Africa. So rand is looking weak. We have taken more money offshore, but we've done it with protection, some direct, some using optionality so that when the rand does strengthen later on, with the funds don't lose money when the rand strengthens. So we've increased our global exposure, but with protection is the bottom line of that story. And otherwise, the portfolios have been relatively stable. As I said, overall we are overweight equities. We do think that risk will recover into the end of the year. We are now moving to positive seasonalities. Sell in May and buyback on St. Leger's Day. That's just around the corner. So we do think that the positive seasonals, as well as The fact that the financial conditions are starting to loosen will benefit risk assets. So we do maintain our overweight equities. Our equities are still relatively defensive with healthcare in China, but with buying some more US and some more fourth industrial revolution and some more growth, we've obviously taken that a bit more, a bit less defensive and a little bit more aggressive on that. But overall, our equity weighting as a whole is still quite defensively positioned, with value defending us against rising interest rates, with China being quite defensive because of its own internal growth support. Healthcare remains defensive against inflation, and now we're actually seeing some tailwinds coming through into fourth IR, and sustainability certainly seeing its own tailwind drivers. So we quite like our equity allocations, even though we are overweight equities that are on very specific themes, which should prove defensive despite the slowing revenues globally. Okay, we've all seen this chart, so there's not much change here, just adding in the sustainable economy as our fifth pillar in terms of our global themes. And you can see there that the disruptive technologies through fourth IR, the number of pluses has increased because we've increased our overweight there. We've brought it in line with health innovation and the others, but our biggest overweight is still EM China, where we think there's a lot of upside. Particularly in the big dual-listed Chinese shares, now that the audit requirements have been almost finalized for US-listed Chinese companies. We think there'll be some support to those share prices over the next couple of months. So we retain that as an overweight. Okay. Hope I didn't bore you too much. Let me stop the share and let's get to some questions. I see not too many questions today, so we'll hopefully be finished by 12. Okay. And Andrew does ask about the China risks, and yes, Andrew, as I certainly agree. From a geopolitical risk standpoint, the risks between China and Taiwan have risen. But they've gone from negligible to slightly less than negligible. And while I think it's a very high impact event if it happens, the probability of it happening is minute. We have to believe that there's no way the US would want World War III, and it would lead to World War III, and it would probably be a World War III that the US would lose. As I said, China has the largest navy in the world. Taiwan is very, very far from the US. The US has got a number of other things to worry about. They've got political deadlock also happening with their own set of voting happening coming up soon. So I think there's a lot of saber rattling as a result of the elections coming up. But I think that, and certainly, I'm not downplaying China-US risk. I mean, they are the biggest enemies going forward from an economic perspective and from a tech perspective. So I do think that there will be the continued harsh relations between US and China. But China invading Taiwan is certainly not something that is likely. China is going to try and win this war on the tech sector. They are throwing vast amounts of money at the tech sector. You can see that's happening. Those 100 flowers are already blooming, and they want to overtake the US as technology leaders. They want to overtake the US in terms of growth, in terms of new technology, in terms of exporting quality goods, and that is definitely their focus. Christopher asks about the G7 price cap on Russian oil's exports, and whether that's going to be effective. Yeah, Christopher, I can, like all the sanctions, so far the sanctions haven't been effective. So far the sanctions have seen Russia export as much oil as they want to, and the oil price has doubled. So sanctions haven't worked. Whether the price cap works, it's going to be difficult to see that unless there's a very strong ability for it to be policed. And I know they are trying to police it through reinsurance agreements. So to some extent, they may be able to police it through reinsurance agreements on shipping, but at the same time, there'll probably be ways around that. So, I'm not convinced that the positive is going to outweigh the negative, but we'll see what happens. I think it's going to be more likely the same, that sanctions hurt the rest of the world and don't hurt Russia. And Christopher, just to ask, similarly in terms of gas in Russia, turning off that gas supply, yes, you're spot on. It's again saber rattling. It's highly unlikely there are technical reasons in terms of there has just Nord Stream 1 has just gone through its refreshment. They had gas supply at 40%. There's no reason besides the fact that they are just reacting to the sanctions. So this is very much a political standoff. That said, Europe is rushing to find alternatives. They have just signed an alternative with liquid natural gas being supplied from Australia, and they are turning on coal power stations. The EU has reached, or nearly reached its gas stockpile limit. So there's a strong likelihood that very soon, even with that gas being turned off, that there will be alternatives in place, whether it's oil, whether it's coal, whether it's nuclear, or whether it's liquid natural gas that are shipped in. Alternatives are quickly being put into place. And with the price caps that are now being put in as well, the economies may not be hurt as much as expected. Johan asks, can Sygnia add a resource unit trust to its available funds on Alchemy platform? Johan, I'd be surprised if there isn't something there already, but certainly I'll have a look at that and speak to the team to see what's on Alchemy and if we don't have an exposure to a resource fund or a resource ETF. But it's a good request. Hannah's asked about China demographics and how that impacts our strategic long-term views. And Hannah, that's a fantastic question. And certainly demographics are one of the reasons that we have our strategic pillars. So, we are very concerned about aging populations. It's a potential GDP growth is made up of productivity, how cleverly you work, which has seen declines over the last 2 decades, and number of people in the labor force. And that started to see declines in Japan 2 decades ago. That started to see declines in Europe nearly a decade ago. That started to reach a point of inflection in China now. And it's likely to reach a point of inflection in the US in the next 5 to 10 years. So certainly shrinking labor forces is a very big win to GDP growth. And China is not immune from that. Our long-term play in terms of emerging middle class is emerging Asia, and it's not just China, and we think the majority of that is going to come through in India and other parts of Asia, not just China. But China in itself is seeing a rapidly rising middle class, just in terms of how affluent they are, and as that level of affluence rises, it means they'll be able to spend more. So China's more just in terms of improving living standards, whereas the rest of emerging Asia's number of people moving into the middle class. But all of it also linked to not just number of people, it's all about improving living standards and rising affluence, which you have to have the money to buy the extra toaster. That's what it's all about in terms of that theme. It's not just having people. And that's one of the reasons why, unfortunately, Africa is not in that theme. Africa's got the fastest growing populations in the world by far. But the lack of education is resulting in a lack of a rise in the LSM living standard measure, which is tragic, but it is what it is. Education needs to happen on the back of employment growth. Population growth to allow employment growth. Tracy asks if we think that house prices will fall in Australia, New Zealand, and Canada. It certainly has to happen. A lot of those houses were bought on zero interest rates. It's not sustainable. Yes, a lot of them also used long-term mortgages to lock that in, but mortgage prices are also rising. And that means as new mortgages rapidly rise, those house prices cannot stay where they are. It's just impossible. The house prices are incredibly expensive. And as the cost of buying them rises with mortgage rates going up, there's going to be an impact on those house prices. So we've already seen it in the US, where the US is going to be more protected. They've got a much smaller housing stock than New Zealand, Australia, and Canada. They've seen less construction than New Zealand, Canada, and Australia, and they've seen less price rises. Whereas New Zealand, Australia, and Canada have seen a much larger stock of housing come online and much faster price rises. They're going to see the same increase in the cost as those mortgage costs go up. So it'll certainly have a much bigger impact in the US. Tom asks about the ETF. Yes, the Sustainable Economy ETF will follow our usual IPO processes. Those will all be announced on Sense the moment we have JSE confirmation. The email is ready to go. We're just waiting for the JSE. Louise asks if the positioning in terms of our global thematics is onboarded. In fact, all our positioning is used in skeleton balanced range. Skeleton balance 40, skeleton balance 60, certainly. So our skeleton balance range, skeleton balance 70 being my favorite. We're overweight South African bonds, we're overweight healthcare, we're overweight genomics. We've got China, we've got emerging markets, we've got fourth industrial revolution. We're going to be adding a sustainable economy. All of those views are that we put into our funds, and we think that that's going to result in the best long-term performance of those funds. And that's, as I'm sure all of you know, Sygnia's key driver is quality at a low price, passive, not just passive, but low cost. And we think that the best way to get exposure to growth themes is by passive investing in those themes. Yes, you can buy active managers, but they will give you, they'll just pick those same themes and charge you an active fee. Not only that, but we've seen a lot of growth managers, active managers, do very poorly recently because they've held on to that theme too long. And yes, our themes have seen similar. Fourth R hasn't been immune to that, but we're not charging active fees. So it's one thing to have to weather the storm and hold on to your fourth R portfolio as that theme goes through its cycles, but to pay active fees while that same theme goes through its cycles, well, that just seems a bit unfair. Anyway, it's part of our philosophy. Is all of our funds have low cost passive to bring down the overall cost. All of our funds have thematic themes to achieve growth at a reasonable price, and all our funds have, all our balanced funds at least, have top-down risk management through tactical, thematic and tactical asset allocation, which ensures that we make sure that the expected return for the expected level of risk is optimal. George asks where I see the gold price going. George, the gold price, as far as I'm concerned, I mean, there are very, very many things that drive the gold price. One of them is Armageddon, and then certainly, as the risk of World War III rises, so gold will rise. And if you are worried about World War III, it's always good to have some gold in your portfolio as a hedge. It will rise. If you look at the fundamentals, in terms of gold being using as a purchase power parity, in terms of using gold to buy bread, well, gold has left inflation way behind over the last decade as it accelerated rapidly. It's basically doubled. So gold really isn't being bought as an inflation hedge anymore. What gold is being bought for is as a safe haven, as an alternative to developed market bonds. And that's why when we saw the percentage of negative yielding developed market bonds reach a peak some years ago, gold hit its high at the same time. Now, as we see fewer and fewer developed market bonds have negative yields, so gold price is coming off because people can sell out of gold and buy developed market bonds that are giving you some defensiveness and but at the same time giving you a yield as well. So you might not like US bonds because of inflation, but you can buy Swiss bonds, or you can choose your bonds that you want to buy. But as long as bonds are an alternative to gold, gold is going to see a headwind as long as interest rates continue to rise. So yeah, assuming no World War III, we think that even with the weaker dollar, that the gold price is probably going to move sideways. Sygnia doesn't have a specific biotech fund. We have the Sygnia Health Innovation Fund, which invests in a diversified portfolio of biotech and genomic stocks. So that the Sygnia Healthcare ETF invests only in market cap weighted healthcare stocks. That's your biggest 160 companies by market cap. Whereas the Sygnia Health Innovation Unit Trust, that's an active fund that has an exposure to the big caps, but it's also got exposure to OSE, which is unlisted, Oxford Sciences Innovation, and it's also got an exposure to a diversified portfolio of biotech and genomic stocks. So if you're looking for that exposure, you need to be in the unit trust, not the ETF. Wayne asked why there hasn't been an inverse correlation between equities and bonds with the latest recessionary concerns, purely a result of quantitative tightening. Quantitative tightening meant that at the very time when bonds should have been giving you protection, central banks around the world were selling bonds, quantitative tightening, they were unwinding their balance sheets, and so bonds had a bigger sell pressure from central banks selling than they had buying pressure for people trying to buy defensive assets. And that's exactly why we didn't hold any global bonds, and why we still don't hold any global bonds, and why we still don't hold any gold, because as QT, quantitative tightening, is unwound, there will be selling pressure coming into the bond market. Just a question here on Sygnia S&P 1200 versus Sygnia S&P 500. Sygnia S&P 500 is US only and doesn't have any ESG overlay. Sygnia S&P 1200 is a global portfolio, so that's got about 60% US, 40% non-US, including about 6% emerging markets, and then it's got an ESG overlay. So it depends if you want a diversified global exposure, 1200, or if you want just US exposure, that's the 500. Good question from Gideon, who wants to know the difference between our China New Economy Unit Trust and our China New Sector ETF. So again, it boils down to whether you want active or passive. So the New China Sectors tracks the S&P New China Sector Index, so it's passive. China New Economy Unit Trust is active. There we pick our own sectors that we think will benefit from China's 5-year plan and China's growth plans. So we use quite a slightly different sector differentiation. And then we also overlay other themes. So we've got a bit more small cap. So just like we've got some other themes like genomics coming into the healthcare unit trust, or our fourth industrial unit trust has got a value tilt and it's got some OSE. Our China unit trust has also got a few tilts to where we think things are a bit more exciting. So the ETF, just like all our ETFs, is passive and cheaper. Unit trust is a little bit more expensive, but it's active and it's got a few top-down tilts between other sectors and themes that we think are more exciting. So it depends what you want. Rachel asked about political interference or control of the Chinese government to the Chinese stock market. I think that the concerns that you have are valid, and that certainly it's what caused the big sell-off 2 years ago when China was very much focused on making sure that the emerging economy, emerging middle class had access to cheap housing, had access to cheap education. But they've now no longer worried about that. They're now worried about growth, and they've made promises that they aren't going to make the same mistakes they made 2 years ago. So, and certainly, if you just look at the actions in the last 6 months have been very supportive of deregulating the tech sector and supporting tech growth, as opposed to what happened 18 months ago. So, common prosperity, which was the drive nearly 2 years ago, has now been reversed to letting 100 flowers bloom, which is all about tech deregulation. So common prosperity, tech regulation, letting 100 flowers bloom, tech deregulation. Yes, there's nothing that could stop you from changing that, but I think they were surprised by the impact it had on the market. the broad market, and right now they need as much growth as they can get. They're trying to grow out of a growth hole because of their property bubble, which has burst, which will be a headwind for quite some time. So I don't think they're going to reverse that anytime soon. I think there's a couple of years at least before they start getting, brave enough to reverse that, if ever. Mark asked about the Sygnia all bond fund year-to-date return being 0.6% versus the yield. So the yield is about, I think, about 10%. The historic return is low. So over the last year, you earned a yield of 10%, but you lost a capital return, I think, of about 6%. So I think the 1 year return is about 4%. That's because bond yields rose. We're expecting bond yields to fall, which means going forward, we'll get a yield of 10% plus a capital gain of probably 6%. So we think a likely return of 16% is more probable over the next 12 months from bonds. But going back, your historic return and your future return is all about capital plus income, whereas right now the yield is still around 10%. And that's what's lovely about income maximizer. If you don't need to tap into your capital, you can afford to just sit there and spend your yield. So you get, even though your one return is only 4%, your yield was 11% over last year. So you can actually spend 11%, draw down 11% without touching your capital. And that's the beauty of that fund as an income maximizer in terms of giving you huge amounts of income without having to touch the capital, as long as you focus on spending the income and not looking at the capital returns and not spending that capital. Bruce asked about our preference for Itrix EU versus Itrix UK. Well, we are underweight the EU and we are overweight the UK. There will come a time when we will change that, but right now we think there's still too much risk, and it's one of our few defensive positionings we've got against rising energy prices in Europe, and that's being overweight the UK, so we do remain overweight UK and underweight EU. Gregory asked about South African inflation. So it's a good point, Gregory. I did forget to mention that. It was on the slide. South African inflation came out quite high because of high energy prices, whereas core inflation remained mute at 4.6%. And we're already in September, we're expecting petrol price to come down by R2. So inflation, like other emerging markets in South Africa, is going to come off quite rapidly because of the energy tailwinds. And our core inflation never really got out of hand at 4.6%. There's just not enough growth in South Africa to pass on that inflation. So that's one of the reasons why we are overweight South African bonds. We just think that inflation is going to come down quite quickly in terms of a headline CPI, and core CPI is going to remain around target. The Sustainable Economy ETF hasn't been launched yet. Please look out for that. That's 28th of September. Tom asked a good question just in terms of 1970s and what led to 1970s war with Israel Arab war, and where are we heading? And I think that's which I've mentioned before. When the pie is growing, everyone's happy. When the pie is shrinking, people are fighting over smalling pieces of a dwindling pie. Things get nasty, and that's why we've seen over the last year, we've seen Brexit, we've seen US-China trade wars, we've seen invasions, Russia's invasion. It's all a result of slow growth, falling living standards as a result of falling growth, people becoming disenchanted with governments, people overthrowing governments or voting new governments in, a lot more protectionism being spoken about, a lot more nationalism, a lot more left and right wing, but less central, just basically a lot more uncertainty and volatility. And I think that's something that is here to stay, certainly within markets, but also within geopolitics. While growth is low, and growth is going to be low for the next decade, people are going to be unhappy, and there's going to be a lot of volatility. So that's again another reason why we have to find pockets they're going to do well in these themes of crises. And that's why we do like healthcare as a theme, because it is benefiting from the COVID crisis, and why we do like renewables and sustainability as a theme, because it's actually benefiting directly from the Russia-Ukraine war. And the themes we found are themes that are defensive to the volatility and the slowing growth that's going to happen. And it's going to be tough. It's not only the fact that we are in a tough period with low growth that could lead to further civil unrest. It's the fact that over the last 40 years, interest rates and inflation dropped from 16% to 0. And that meant that every other asset price did well. So over the last 40 years, if you were invested in the market, so people are currently retired and nearly retired, if you had a lot of assets over those 40 years, you not only benefited from your income, you benefited from all the future income that was going to happen, because interest rates discount future income. And as those interest rates fell, prices rose, and there was a movement of wealth from the future to the past. That's now done. Best case we can hope for is that interest rates don't go up much more, and that will then mean that we won't start having capital losses. But even if we get to a point of equilibrium, where over the next decade, interest rates just move sideways and there are no losses, there's not going to be that huge windfall of capital gains. That's gone. So we basically are starting to live off the income of our assets, but the income of our assets is low. I mean, you look at yes, it's picking up slightly now with inflation having ticked up, but it's still very, very low. And to live off just the income of an asset is difficult when income is so low. When interest rates were 16%, it was easy to buy bonds and live off them. When interest rates are 2%, it's a lot harder. So people have to save more, which is another reason why growth is low. So it becomes this we're stuck in a rut. We really are. The next year is purgatory at best. We've avoided a hell or depression by having done quantitative easing, but all it's done is created. It's just spread the hell over the next 10 years and created a short-term hell into a long-term purgatory, and it is going to be tough. So when it comes to giving advice, people need to retire later. People need to save more, and from our portfolios, you need to be more diversified. You need to be lower cost. And you have to have more themes that are going to be defensive against this volatile environment. So, we believe we've structured our portfolios, particularly the offshore portion of our portfolios, very, very well to be defensive against this next decade. But it's not going to be easy, unfortunately. It's going to be ugly. So yeah, that's just the reality that it is. And the sooner you can get people to save more and accept this reality, the better. South Africa, we're a little bit insulated. We've had our own problems, which has kept growth low in South Africa, artificially low, but we've had a lack of reforms. We've had corruption, which has kept growth lower than it should have been, and it's kept interest rates and interest rates higher in terms of the long end, higher than they should have been. So actually, to retire in South Africa now is not too bad. You can, if you can buy an annuity which gives you 10% yield, that's pretty decent. You don't need too much capital, and certainly you need 3 times less capital than if your interest rates are 3%. And at the same time, South Africa is sold because of all the lack of reforms, that it is looking very cheap, which is why a number of active managers are overweight South Africa, and we do see the value there. We're just concerned that right now we're still in a value trap, and we're waiting for more concrete evidence. And maybe we'll, when it comes to the end of year ANC elections, that we could see some positive catalysts, or maybe even earlier than that. But right now, despite the value in South Africa, we prefer bonds to equities. Timothy, I'm not sure in terms of how you get Ghana exposure. Please send an email to admin@sygnia.co.za, and they will be able to help you speak to the right person. Mike asked if the US-China auditing regulations will have an impact on Tencent. Not directly, Mike, but indirectly, it should be positive. And that, I see we're spot on time at 12:15. So that is a wrap. Thank you so much. Thank you so much for joining me. Thank you so much for the questions, and I hope that it's been useful. Have a good month, and we'll speak to you all again next month. All the best.